doing this, so maybe we should not do this given what the mistakes I'm going to make here. But welcome, and hopefully this will be interesting. This is going to be more academic, so I'm going to be talking about what the latest research is, where we are and what we're thinking. So I'm going to summarize a whole bunch of papers and try and talk about what's been done in the literature, why we care about it, like that. Right? So three basic things, and I'll talk about essentially what's happening. So let's get started. Right? Liquidity means different things to different people. Right? For instance, to a farmer, that's liquidity. My son is a college student, right? He's at Georgia Tech, not far away, and he's actually joined a fraternity. He's actually living in a frat house, and to him, I think that's what it means. To an environmentalist, let's take a look at what it means. So these are more interesting, but let's take a look at what it means to a financial economist. A little bit more boring than what it means to a college student, but let's take a look at it. Ability to buy or sell a large quantity of an asset quickly and at no cost. Right? There are a lot of themes here. You're going to talk about bid-ask spreads and price impacts, and so all of them are sort of looking at different aspects, but essentially this is what we're trying to get at. Right? Can you get in and out of markets quickly, large quantities, low cost? Right? That's essentially what we'll be focusing on. Who cares? Right? Why do we care about it? Market participants, traders, money managers. Right? If you're going to trade, you don't care. Right? You might take a big hit if you're trying to get out. So, you do care. Regulators, here, exchanges. New York Stock Exchange, you don't care about liquidity. You want trading volumes, you want lots of people coming and trading with you. Federal Reserve. Federal Reserve is pumping money into the system. If liquidity dries up, they do that. Let me show you a quote. Academics, we are worried about liquidity. Right? A lot of recent work on liquidity. Again, a lot of it is driven by what's happening in the markets, but we do care. A lot of stuff going on. So let me use this quote. Illiquidity means that it has become more difficult to buy or sell a given amount of bond, but the most popular treasury issue. Right? Again, buy or sell, spread between prices at which investors will buy and sell is widened. Amounts for which Wall Street firms deal have shrunk across the board. Debts have gone down. That's what they're talking about. For investment grade, high yield or junk, emerging markets, and bonds. The sharp reduction in liquidity has preoccupied the Fed because it's the lifeblood of markets. Right? At least the Wall Street Journal thinks it's very, very important. And the Federal Reserve is pumping it. So at least somebody thinks it's important. So this quote was from 1998. Right? Let's take look at something more recent. So every 5 years we have this 100-year flood, and this is one of the more recent ones. Market liquidity risk when a market freezes and a portfolio manager can't buy or sell because there's no one willing to take the other side of the trade at anything approaching a fair price. Right? Again, you're thinking of ability to trade large amounts quickly, right, and without too much cost. So getting at that peak. Okay, this is from January 2010. Emerging markets crisis of late 1990s caused stock and bond markets to both freeze and go into free fall. The dot-com bust that began in the spring of 2000 caused buyers for internet companies to vanish nearly overnight, leaving funds that owned the stock stuck with holdings they couldn't afford. And then came the events of 2008, in which markets of all kinds of corporate and securitized debt phased out. So, of course, people care about liquidity a lot. Right? We talked about this in 1998. We talked still talking about it in 2010. I'm sure if you look at the Wall Street Journal in 2015, you'll have enough quotes talking about liquidity. Right? People care about it. If you're a trader, if you're a trader, it's important. Okay, why do we care? And these are the things I'm going to focus on. Okay? Liquidity has an impact on expected return and thus the cost of capital. Right? And here I'm talking about just the level of liquidity. This is going to be important. I'm going to show you papers that provide evidence about this. That's a bit good. Asset pricing indicators, level of liquidity, liquidity risk matters. Right? So recently there have been a whole bunch of papers talking about liquidity risk. So we talk about liquidity risk. And liquidity impacts market efficiency. I'll show you some results about that. Right? So recent work has been done showing about how liquidity impacts efficiency. And liquidity in the business sector. Recently there was an interesting paper in the JF that talks about liquidity predicting the business sector. So I'll show you. Okay, measures of liquidity. We have been used to this, so we have used. So we have the quoted spread. That's just the difference between the ask and the bid. We have the proportional quoted spread. Right? That's the quoted spread divided by the midpoint of the bid and the ask. We have the depth. So you take the depth of the ask, the depth of the bid, take an average of the two. We have the effective spread, which is twice the absolute value of the transaction price minus the midpoint of the ask spread. We have the proportional effective spread, and we take the effective spread and divide by the transaction price. So these are standard measures. Let me give some more measures that are out there. Trading volume or turnover. Right? IBM has higher trading volume than Chuck E. Cheese's. These measures are correlated, but not perfect. The role measure. Negative serial covariance in price change, in returns. Square root of the negative serial covariance. Again, this has some assumptions built in. Right? It's going to assume that there's no information or no serial correlation in all of this stuff. So that's one. The Kyle lambda. Kyle lambda is the way to understand this. So Kyle lambda is the price change regressed on the signed order flow. Q is the signed order flow. Right? When you look at TAC, you can sign the order flow using the Lee and Reddy order flow. Right? So you know what the sign of the trade was, whether it was a buyer or sell, multiplied by the volume of the trade, that is the signed order flow. So the lambda is going to be the Kyle's lambda. That's the price impact measure. And then we have the change, D is the sign of the order flow, and the change in the sign of the order flow from last period to this period, multiplied by psi. And I talked about how Saka uses this in his we have the immured illiquidity measure. A lot of people are using the immured illiquidity measure because it's easier to estimate. Right? You just need interest, you don't have to go to CAC to estimate this. Right? Transaction data are much harder to work with. So the immured illiquidity measure is simple in the sense this is the absolute return of stock I on day T day T in month T. Divided by the dollar volume on that day, and you're averaging over the month. So you're getting an average, sort of a price impact measure, right? How much is the return move for a given dollar volume, and you're averaging over the month. Sort of a price impact. And this is relatively easy to estimate, and this has become very popular. And in fact, this is quite nicely correlated with the other measures such as quoted spread, effective spread, and things like that. Right? So the immured measure has become quite popular. The other measures have to go to transaction data, that becomes harder to estimate. Okay, so this is from French 2008, his presidential address. This looks at the annual turnover of NYC, APEC, and NASDAQ stocks, 26 to present. Right? But because of the huge run-up that we are having in recent years, this is not new. It's something that happened way back in the 1920s as well. Right? So what we will focus on, I'm going to show you something about what's been happening since the tax data came out. So, but again, this was about 200% turnover a year, and this data ended in 2006. This is from French presidential address. So there was high trading volume, initially high turnover, and it's starting to come back up. And we're going to focus on what's happening more recently. Okay, so recent trends. This is when you look from 93, when the tag data became available, ends in December 2008. This is with S&P stocks and non-S&P stocks. Trading volume has gone up, and it's gone up tremendously in the last few years. Right? So if you look at, let's say around here, let's say it's around 25% turnover. What is 25% turnover? Every 4 months, the entire stock market is changing hands. And 3 times a year, the entire stock market is changing hands. Right? That's really hard to do. Right? So the California paper was basically asking this question: why do we trade so much? Right? Why is there so much trading? So this is one question that the PhD student might want to think about. Right? Why is there so much trading in our exchanges? Right? We need so much trading for price discovery. And again, there is now a new debate with the high frequency traders. For instance, are they really helping with price discovery? Are they hurting liquidity? Should we be taxing high frequency traders? Are they hurting other market participants? So again, a lot of this trading volume is coming from high frequency traders. Right? So the question is, are they adding value? If they're trading in millions, right? And why is there so much trading value? So Ken French is trying to talk about that. Like why do we really need so much trading in price discovery? So that's a big question to think about. Okay, so trade size. Look at what and having trade size over time. Right? Now, if you look at the high frequency traders, they're often trading less than less than 100 shares. Right? There's a recent paper by Mohit Ohara and Mao Jet, which looks at a lot of these trades are less than 100 shares, which are not even picked up by a tag, 16% of trades. Right? So this is what the tag data, but trade sizes are gone down again because what the high frequency traders are doing is they're trying to ping the market, trying to figure out pretty orders taking it back, trying to figure out where the market is and whether they can make money supplying it, for instance. So they're supplying small sizes, they're small sizes. We have seen that a lot. Huge decline in trade size. Look at the number of trades. On the left-hand side, that's a log scale. Look at how dramatically this is increased. Right? Less than 1,000 to over 100,000 and come back down. If we extend this graph, I think it's come back down after 2008. So the number of trades has gone up dramatically. Again, why do we need so much trading in the market? That's the question. These are trades that are less than $10,000 each. So as you saw that the size of trades has gone down, the trade less than $10,000 has gone dramatically, right? Less than 10% to 60%. So lots of trades are now small. Even the institutions are trading small amounts. Technology is changing. They can. It's really easy to break up the trade. And with co-location and stuff, really easy to trade that. Trade greater than 10 million, so this is a mirror image of what we just saw. It's again declining. It was over about 95%, about 25%. Huge decline in the large trades. The small trades have gone up. Proportional quoted and effective spreads. Right? So I just extended the data. The other data was from paper we had in JP. So I just extended because this is where the crash happened 2008, and it turns out that the downward trend is continuing. There is a huge decline in proportional quoted and effective spread. You start with quoted spreads. The black line is the quoted spread. The gray line is the effective spread. Right? So you start at 0.5%. Trading is expensive and around less than 0.1%, 0.05%. Trading costs have gone down. Technology is improved. The high frequency traders are there. The market is changing. Change in commission. This comes from Ken French. So if you look at where commissions were 1980, 2006, right? Huge decline in commissions. Right? These are OTC commission, trading gains from market making, and exchange commissions. Right? Across all dimensions, it's become cheaper to trade. Right? I showed you the bid-ask spread. The commissions are low. So trading is becoming easier. It's becoming cheaper. Right? Go back 25 years. You had to call a broker to trade. Right? Now who calls a broker? It's all online. It's become easier to trade. It's become cheaper to trade. Maybe that's the reason why trading volumes have gone up. And we have a paper where we actually use the identification strategy of how the change in the tick size reduced cost and that helped to increase trading volumes. So if you look at right now the change in the tick size using US data, we see the increase in trading volumes. Okay, recent trends. This is the inflation adjusted annual illiquidity valuated measure, right? From 1975 to 2008. Again, this is very easy to measure if you're going to look at only the crisp data. Right? Look at the tremendous decline. We're not seeing the cross section there. This is a valuated average. But there is some cross section differences. But again, overall, there's been a huge decline in illiquidity. So this is the illiquidity. Right? Depth. And these significant drop that you see here, and this was the change from 1/8 to 16 tick size. This is decimalization. Right? So you see this huge declines. Again, this is a valuated average of depth in the number of shares used in the tactic. So huge changes about what's happening. Asset pricing implications. So let's start with the level of liquidity. So I'm going to talk about level of liquidity. I'm going to talk about liquidity risk, and then we'll talk about efficiency. So let's talk about level of liquidity. So what is the literature here? The first paper in this field was unmuted and Goizueta. They looked at the bid-ask spread and expected returns. Right? What impact does bid-ask have on the cross-section of expected returns? We have a paper with Brennan and Supra where we look at turnover and expected returns. I'll show you results. Then we have the price impact and expected returns that Brennan and Supra had, 1995. So they actually estimated the Kyle lambda from transaction data. And we have a paper where we look at the buy and sell price impact and expected returns. Okay. And let's talk about these papers. So let's start with So their sample was 1960 to 1979, and they got relative spreads from Fitch. Right? In those days, you did not have track data, so you actually got one measure of spreads a year for a stock. Right? So what they do, they took the beginning of the year measure of spread, end of the year measure of spread, they took an average. Right? Hans Stoll and really have papers with this. So Hans is working with Hans selected the same house. So basically, one measure of spread again. And that's what you get, that's what you have to work with. Now we are spoiled because of the time. So what they did is they looked at 20 overlapping periods, 11 years each. They estimated beta over the first 5 years, in the 5-year portfolio formation period, and they estimated the beta over the portfolio formation, and they looked at what's happening in the 1-year cross-sectional test period. So they had this rolling 11-year window. Right? So first 5 years, beta estimation, portfolio formation, and then cross-sectional test period. And they sort sequentially, first by spread and then by beta, 7 by 7 portfolios. Right? Maybe they're not enough stocks for 10 by 10, 7 by 7 portfolios. And then they have pooled time series cross-sectional regression. So this is the regression. So they have the 7 by 7 portfolio returns, excess returns on the beta of the portfolio. This is the spread measure. So this is the excess spread at a given point in time, given year, in excess of its time series average. Right? So if the spread is higher than its time series average, you should have some impact on the returns now. So that's what this is picking up. This is the year dummy. This is a dummy for the portfolio, the 7 by 7 portfolios. Okay? And let's show you the results. So look at, so we have GLS, we have OLS, but let's just take a look at the OLS. So this is the first coefficient on the spread. Right? So if the spread is higher than the time series average, what happens to returns? That's what they show. So this is over different spread portfolios, largest to the smallest spread, and look at what happens. When you have the spread, in the largest spread portfolio, the spread that particular year is higher than its time series average. There's a huge impact on the second returns, and this goes down. Okay? Declines 1 or 2. So one of the main results is, look, spreads have an impact, liquidity has an impact, illiquidity has an impact on return. Okay. So this was the first paper to talk about illiquidity and returns, the cross-section of returns. So this is that first measure here. Okay. So this was this data. And let's take a look at this CI, so what's happening here. So in this graph, you have the beta group against the spread group. Right? So 7 portfolios beta, 7 portfolios of spread from low to high. And what they do is they set this to 0. So the 7 portfolio is set to 0. Everything else is measured relative to this 7. So that's why all the numbers look negative. Right? So just keep in mind that it's just being measured relative to this portfolio. Right? So if you look at, the idea is, take a look at any beta group. Right? When you go down beta, you should see returns that should increase as beta increases. Right? As the liquidity increases, your expected return should go up. Right? And that's what you see. Right? It becomes less negative. It seems to be increasing. And when you look across betas, again, it does 108, 117, 103.2. So high beta stocks should earn higher returns, right? So forget the mean, look at the difference between 1 and 7 and 1 and 7 this way. That's the idea. Again, high spreads should earn higher returns. That's the basic thing. And the 7 portfolios here are telling you that is some kind of a piecewise linear regression. Okay? As the beta increases, there's a concave function returns versus as spreads increase, it's a concave function of returns versus expected returns versus spread. And that's what we see. And this was the first paper to actually try and look at expected returns measured and liquidity, expected returns on liquidity and how liquidity has an impact on the cross-section. Okay, so this is a paper where we look at data from 66 to 95. Data from crisp and CompuStat, standard data set, nothing fancy there. Common data regressions, we look at individual spark regressions. And the way we run the regression is we run it on risk-adjusted return. So take a look here. So what we have is the two-step regression. First, we estimate the time series beta on individual stocks. So we did rolling regressions, 5-year rolling regressions. We get an estimate of the beta. And then we are running cross-section regressions by taking the risk-adjusted return and then regressing the risk-adjusted return on the characteristics. Right? These are the characteristics. And the idea is the beta is measured by error. Right? There's going to be noise in this. And usually what you do, you form portfolios to try and handle that noise. Right? What we're saying is, let's move this beta to the left-hand side. So when we use the risk-adjusted return, this beta is on the left-hand side. And when we run this regression, that error, the noise in estimation of beta is captured by zero. So it's not going to have an impact on the coefficient estimates. Coefficient estimates are going to be unbiased. So this is one way of doing cross-sectional asset pricing with individual stocks. Like if you put the beta on the right side, there's a lot of error in variables that we're looking at. Okay? So that is a surprising question that I'm looking at in a different paper. But what we're doing here is we move the beta to the left-hand side and try and estimate the coefficient estimates on the characteristics. Right? So we're getting, every month we're going to run this cross-section regressions. We'll get a time series of these monthly cross-section estimates, which will estimate, try and figure out how does volume, for example, impact the expected returns. So the risk factor we use, Power French, Conrad project. Conrad project is basically a factor analysis, trying to get the factors from the data. Okay, so let's take a look at this. So simple excess returns. Then look at the different characteristics we have. Right? These are the standard characteristics: size, book to market, price, and then we have dollar volume, New York exchange dollar volume, Nasdaq dollar volume. We have the yield, we have past returns to get the momentum. And the reason we have to measure dollar volume separately for New York and Nasdaq, New York and Amex and Nasdaq, because in the Nasdaq you have trading amongst dealers and that can inflate the trading volume. So we measure it differently across different kinds of trades. So let's take a look at the results. Book to market is positive. Size is positive finally, but it's highly correlated with the dollar value. So if you put turnover there, size is turnover. And you can actually show this when if you write this down carefully. It will happen. We see momentum, but focus on dollar volume. New York and NASDAQ, right? Strong negative coefficient, especially for New York Stock Exchange. And after we adjust the risk, right? Strong negative coefficient, New York and NASDAQ, especially for New York. Okay? What is this telling us? Stocks in the cross section, stocks that have a higher trading volume, dollar trading volume, have lower expected returns. Right? Again, this is crisp and concrete strategy. At this point, we're not even looking at fancy stuff when it comes to that. Crisp and concrete strategy, higher dollar volume, lower returns, higher liquidity, lower expected returns. Sort of makes sense. And you might argue about dollar volume being the right measure. Well, we had beta spread, we had only one measure a year, one number a year for each stock. Here we have monthly cross-sectional measures. And as the literature progressed, we'll get more fancy. Right? We'll start looking at price impact measures and stuff. But at this point, this is what people are doing. Turnover is a measure. Dollar volume. You also use turnover and you get similar results. Turnover or dollar volume is okay. So let me show you a more recent paper, and here we're going to actually measure the price impact. So let's take a look. The sample period 83 to 2008, data from CRISP, accomplished added CAC. So ISSN you can get ISSN data on transactions from 1983 to 92, and what we have after 83 from after 92 is from CAC. And the sample and then again, pharmacometric progressions. Individual stocks, we're going to use conditional and unconditional betas. Right? The idea is you can allow time varying betas. Like you can condition on size in the market, you can condition on macroeconomic variables. This is again huge literature on conditional betas. We're going to use pharma fringe factors only. Again, risk adjusted returns as dependent variables because we have to be worried about the errors in variables model of the betas. So we're going to put the betas on the left-hand side, we address the errors in variables. Independent variables are going to include the usual anomalies and the guiding anomalies. So you have to estimate the buy and sell data. So let's take that. And the motivation of this paper is simple, right? So suppose, the way I like to say it is build an analogy with theater, right? So let's say we're going to watch a movie, watch a play. And the play starts, let's say, at 2:30. Right? So people can show up at 2:20, 2:25, 2:15, 2:30. People show up, right? Gradually. And everybody gets seated. If somebody shouts fire in a crowded theater, everybody's trying to get out the door at the same time. And that's when it's hard to get out. Right? That's when it becomes a problem. Right? So the motivation of this is when people are trying to get out, right? That's when liquidity should matter. Right? That's at least anecdotal evidence seems to suggest that. Right? So do we see this in the data? Do we see that when people are trying to sell, the price impact has a bigger impact on expected returns? Right? That's what we're trying to do. So we'll try to measure buy lambda, price impact when people buy on buy trades, price impact when people are selling on sell trades, get two different lambdas and try and see the impact of these lambdas on expected returns. That's the idea. So let's take a look. So we're going to have to estimate buy and sell lambdas separately. So how do we estimate buy and sell lambdas? So let me give you the theory that we usually work with. So we have QT as a signed order flow and DT as a trade signal. Right? Again, I talked about Lee and Reddy algorithm, how you can sign the trades. So there's a true price, MP, which evolves with a random walk, plus the lambda QT. So a signed order flow is going to move the price up or down. Right? So lambda is going to be positive. And of course, this is a true price. We don't observe the true price. We don't know what the true price is. there's a transaction price, which is what we do observe, plus which is equal to the random walk, the true price which we don't know. We observe the price, plus this term which is decided by whether it's a buy or a sell, right? If it's a buy, the true price will be above the observed price will be above the true price. If it's a sell, the observed price will be below the true price, right? So there's going to be some impact of whether you're buying or selling, depending on what you observe from the true price. And the true price is going to move up and down. That lambda is the address selection component. You can say it's a price impact measure of what the sign order flow is making the price move. Right? Is it going to move up or down, depending on whether there's a huge buy order coming in, huge sell order coming in, multiplied with the price impact. That's going to move the true price up or down. Okay? So that's what moving is. So if you first differentiate the price, that's what you can get the equation there. Okay? So what we do to this equation is we separate this lambda into buy and sell lambdas, right? Depending on whether conditional on whether the trade was a buy or a trade was a sell, right? Whether QT was positive or negative. Right? So if you're buying, that QT is positive, there's a certain lambda. If you're selling, the QT is negative, there's a certain lambda. And now we're going to see whether these lambdas are priced in the cross section. Okay? So that's it. So again, let's take a look at, so we have these three different sets of regressions. So 1, 2, 3, these are unscaled. These are conditional size and move to market. These are conditional on term spread, default spread. So we condition on firm specific factors, we condition on macroeconomic factors. The result doesn't matter. We're going to get the same set of results. Oh yeah. Thank you. Okay, so let me focus on these three. Right? The unscaled, the results are the same whether you scale by size of the market or by macro variables. Okay? So again, we have the similar coefficients, the size, book to market, turnover. Right? Remember I said turnover will be negative, and these are only NYC MX stocks. Higher turnover, lower returns, negative. Past returns, this is momentum factors, right? The positive impact of momentum. We know that. We control for annual measure. Remember, higher illiquidity, higher returns. That's what we see. Right? Annual is strong, and this impacts about 2 to 3% a year, typically. The annual measure. Then the point. Look at what we're doing here. We are throwing in the buy lambda. Remember, I showed you last time how you estimate the buy lambda and the sell lambda. Right? Again, this is transaction data. This is every single transaction from 83 to 2008 and 2008. So every month we are estimating a buy and sell lambda for every stock. Right? And then we are running this cross-sectional regression. So we're looking at every single transaction that took place on NYC MX stocks from 83 to 2008. Right? So we have monthly measures of this lambda, and we're going to run these cross-sectional comma regressions every month. Okay. Right, so we get the buy and sell. So let's take a look. So this is the impact of the buy lambda. Right? So when people are coming into the theater, right, what impact does it have on expected returns? And the sell lambda, when people are trying to get out of the theater, right? People are trying to sell stocks. There's an impact. But when we put them together, take a look. The buy lambda is no longer significant. It's the sell price impact that drives returns. Right? It's when people are trying to get out. That's what we really care about. Right? Now, if you remember the quotes I showed you right at the beginning, it was all about trying to get out, trying to find somebody on the other side willing to buy at a fair price. Right? And that's what is separated out. Right? And we see that. And it's a sell lambda that matters. And regardless of how you do the conditioning, how you estimate the asset pricing model, the result is robust. You do not see the impact on the sell side. Right? Regardless of how you do this. Both the buy and the sell are important in the cross-sectional asset pricing test, but when you put them both together, it's the sell that matters. Right? It's when you want to get out that matters. Okay? When you try to get out the door gets clogged. It's not going to be good. So this is, I thought it needed to. But the interesting part of this was when we started, it was a huge data exercise. And we had no idea this is what we can find. And it was very interesting to find this. course, it's sell-side attack. So basically, Ching was a doctoral student at Emory, and he was looking for something to do in his third year. So I said, okay, why don't you look at this? We don't know whether it worked out, but at least we will get to know. And it didn't. Okay, so we just talked about the level of liquidity having an impact on expected returns. So we looked at the bid-ask spread having an impact on returns. We looked at turnover having an impact on expected returns. And we just looked at price impact, lambdas having an impact on expected returns. Okay. Let's take a look at liquidity risk. Right now, there's huge literature on liquidity risk, recent literature on liquidity risk. So we start with commonality in liquidity. And the idea here is that stocks move together. Right? Liquidity moves together. That stocks become more or less liquid simultaneously. Right? And if that doesn't happen, there's commonality in liquidity. If there's commonality in liquidity, if there's a common factor, it should be priced. Right? That's the idea behind this whole equation. That's what we're talking about. So there's commonality in stock and bond liquidity. We have. And there's pricing of liquidity risk. Passive and low, channel periods, etc. So the first paper looks at commonality in liquidity across stocks. Right? Different stocks move together. Second paper, we said, where is this coming from? Right? What is driving this? It's probably contributes from macroeconomic component. So we said, if there's a macroeconomic component, there should be liquidity across markets. Right? And we see that, I'll show you the stock and bond. Right? So there is liquidity across markets. And in fact, we have now more recently worked on liquidity across foreign exchange stock and bond markets. Right? So we're seeing these common themes across markets. There seems to be some underlying macro factors behind this. Pricing of liquidity risk, we'll talk about assets and alternatives. Okay, let's take it. So, starting with commonality in liquidity. This is only using transaction data in 92. This is using the ISSN data set. Again, time series regressions, individual stocks. So, we're running time series regressions of all individual stocks. We can control for volatility and market return. Use leads and lags of change in the market. And you've got to, of course, remember you're running time series regression with a whole bunch of different stocks. Right? There might be cross correlation in the residuals when you're running this time series regression. So ideally you would like to run a seemingly unlimited regression because you've got a lot for correlation. But the huge number of stocks that becomes difficult. Okay? So we sort of control for the residual cross correlation by just sorting alphabetically and measuring the cross correlation. And the standard errors are adjusted for this cross correlation. Anyway, the simple regression is change in liquidity in stock J at time T and change in the market liquidity in time T. Okay? And this is the coefficient you want to focus on. Okay. So again, we have leads and lags. So one term, lag and lead. And remember, these are time series regression for each stock. So we're getting a whole bunch of coefficient estimates. These are the averages, right? Highly significant. But we also tell you how many percentage of those are positive and percentage are positive and significant. Right? Now, if this was just happening by chance, you would expect 5% to be positive. Right? This is clearly much larger than 5%. That's the idea. These are individual stock, time series regressions, and 84% of them are positive, 34% of them are positive and significant. Right? That suggests that clearly there is some relation between the market liquidity and stock liquidity. You've got to be careful about one thing. If you're running these regressions, you should not include the own stock in the market when you're doing that, because that sort of bias the coefficient in the market. So the market does not include the own stock. And of course, we have concurrent lags and leads. This is the sum of the concurrent lags and leads, and these are the estimates for quoted spread, the change in the quoted spread, change in the proportional quoted spread, effective spread, proportional effective spread, and the test. These are consistent. There's strong evidence of commonality in liquidity. Right? The R squares are low. Right? Remember, what this is saying is, does the market spread or the market return, the market volatility explain individual stock volatility, individual stock spreads? Not so. Right? there is a relation between the fact that when the market spread goes up, or the market illiquidity goes up, individual stock liquidity goes up. Right? So they are related in that sense. There is common factors among them. You cannot explain a large portion, but there is commonality in liquidity. That's what this is getting. So if there's commonality in liquidity, we got to think about prices. Does it have an impact on asset pricing? Right? So let's take a look, and let me show you about commonality in liquidity across bond and stock market. Right? Like I said, there's got to be some underlying macro factors that drive this. Right? So there's been a lot of papers trying to understand what is driving commonality in liquidity. Right? There will be papers saying that if the stock is with a similar specialist, there's commonality in liquidity. Right? Maybe the specialist funding liquidity has an impact on commonality in liquidity. So at that point, we were thinking it's got to be some macro factors. So if there's a macro factor, it has an impact on bond and stock. So what we are doing is we compute stock and bond liquidity. We have a VAR model of liquidity, returns and volatility in stock and bond market, and of course a VAR if you have the same lag coefficients, you estimate that more or less. So basically, you can think of this as a VAR with three different variables: liquidity, volatility, and returns in the stock and bond market. Right? So we're running a multivariate VAR, and we're going to look at the coefficients. And let me just show you the impulse response functions. Okay? So you can, there's a lot of stuff in this paper, but let me just show you the impulse response function. And what we see here, right, this is the response of the quoted spread in the stock market to the volatility in the bond market. Right? So the volatility in the bond market has an impact on what's happening in the stock market. Right? So the spreads, the positive and the same. So we show the 95% bands and mean values. Same, the volatility in the stock market has an impact on stock spreads, which are not significant. Returns have an impact. We know that when returns go up, spreads go down, liquidity goes up. So in that another word. So this is what I want to focus on. So when the bond liquidity goes down, the bond spreads go down, stock spreads go down, when bond spreads go up, stock spreads go up. So there is a spillover from bond market to stock market in terms of liquidity. So bond liquidity has an impact on stock liquidity. There seems to be some underlying variable that drives this. And we also looked at Fed funds rate surprises. So if there's a change in the Fed funds, so macroeconomic policy has an impact on a surprise in the macroeconomic policy has an impact on quoted spread in the bond market and the stock market. And bond market we're using are the treasury, I think it's the 10-year treasury that we looked at. So 10-year treasury, beta spreads, stock beta spreads, and we're seeing an impact from what's happening in the bond market, the macroeconomic policy to what's happening in the stock market. And here we're looking at what's happening in the bond market related to bond spreads related to what's happening. And what I want to focus on was quoted spreads, the volatility in the bond market, volatility in the stock market, returns in the bond market, and quoted spread. There seems to be a spillover more from the bond market to the stock market rather than vice versa. Right? And we see that. Okay, let's talk about liquidity risk. So we know this commonality. So remember what we just did. We looked at the level of liquidity. Right? So we looked at turnover, we looked at lambdas, ISL lambdas, they're priced. We looked at turnover. Now we're going to look at liquidity risk. So there are two different aspects here. Liquidity, so the level matters. Right? If IBM is less liquid than Chuck E. Cheese's should have high expected return. Then there should be a liquidity premium. Just the level should matter. The recent literature is not often liquidity risk. Right? The fact that there is commonality, and if you want to get out of a position in your portfolio, if everything is illiquid at the same time, it becomes hard. Right? So how does this beta on an illiquidity factor matter? Right? So that's what the illiquidity risk literature is talking about. Right? So Pastor Sambo, Acharya Peterson, and Sakta, this is what they talk about. They say, essentially the idea is create a liquidity risk factor, get the betas on the liquidity factor, and check whether they're priced. Okay? So just like you have returns, right? You regress the return on stock in the market, return on portfolio in the market, get the betas, see if that beta is priced. They do something very similar, get a liquidity risk factor, get the beta on that factor, and see if it's priced. That's the idea. Okay, so let me go through this set of equations for passive and borrowers. Okay, so they take returns and stock I on day B month T, right? And they're running it on returns on the market, sorry, lag returns, and this is the lag return which is signed. So whether it's a positive return or a negative return, multiplied by the volume. Right? And the idea here is, if there's a large volume, let's say buy volume or a sell volume on a given day, on average, right? So there's a sign of return on the day. So whether there's buying during the day or selling during the day, suppose there's selling during the day, that's going to depress the price, but then the price will come back up. Right? If it's a liquidity effect, it should be temporary and the price should come back up. Okay? And what this gamma is measuring is the fact that this return will come up because we have the sign of the lag return and the lag volume. Right? And the next day, if the price goes up, the sign that changes, that gamma will be negative. That's what's going to measure the liquidity, that reversal effect. So if the idea is that there's a shock, if it's temporary, you should see this reversal, and that's what this gamma is measuring. Right? So they estimate this gamma for each stock, each month, and then they take an average for the month. Remember, they're trying to calculate a factor. They adjust this gamma based on what the inflation and stuff. They regress it on past changes in gamma. They work with this error term. They're basically trying to standardize it, and this is their liquidity factor. Again, then they scale it back. Again, these things don't matter. The basic idea is they're trying to get at this reversal. If the impact, if the unit sell, if it's just a liquidity effect, there should be a reversal, and we should be able to capture this reversal. What they caution against is trying to use these reversal measures in an individual stock cross calculation. Right? These are very noisily estimated. So they said you should not be using this, but to create a factor and then try and measure the beta on that factor, they said it's okay. Right? So you have to read the details. So again, we're going to take standard form portfolios on the standard regression. Right? These are the form of French factors, market, S&P, HML, and they're going to throw in this liquidity factor. Okay? So they estimate the betas of these, and they're going to see this beta, the price. Most specifically, is this beta of the liquidity factor priced? That is the test. Okay. So let's take a look at what the results of the factor. So if these are evaluated portfolios sorted on predicted beta. So they have the beta 10 minus beta 1. So they are sorting on these beta. So let me go to the previous slide. So what they're doing is trying to sort on this data. Right? They run regressions. Think of an individual stock regression. They're running it on portfolios to handle the errors and variables. So think of a regression of a stock or portfolio on that liquidity factor. Right? So you're going to have a distribution of these betas. Then you're going to sort on these betas, form the portfolios against and calculate post betas. Now, hopefully, the idea is form decide portfolios on these betas, look at the high beta minus low beta, and multiply it by the price of risk. And that should be your expected return. And that's what they're doing here. Okay? So, what they're doing here, this estimate is beta 10 minus beta 1. So, this portion of the betas multiplied by the price of risk is what you hopefully get in terms of liquidity risk return. Okay? So, differential in beta, think about it in terms of the stock cap. Okay? If you have a high beta minus low beta, the differential between that multiplied by the price of risk should be your expected return. Right? That's exactly what so the 4 traded factors, 7.56% is your differential return is what they're talking about. Okay? So the reward for liquidity risk in Bachelor December is 7.5%. across the high and low, beta stocks, beta on the liquidity factor. And this is large, this 7.5 is large. Acharya Peterson has something like 2.3%, and they break it down into different factors of about 2 to 3%. In our paper also we have 2 to 3%, but those are levels of liquidity. So this seems kind of high. 7.5 seems kind of high. I was at a conference once, and Pharma was in the audience. He never goes to conferences, but this conference we were in the audience. And somebody asked him, what is this? He said, it doesn't feel right. Like 7.5% seems high. But it's there. There's something there. We'll see something similar. So this is what if you read the abstract, they talk about the 7.5%. 7.5% return to liquidity investment. There's something there. So let's take a look at what Acharya Peterson and what Sakta. So Acharya Peterson, now what we are going to do is try and get a measure of liquidity adjusted capital. So this C is that cost of trading. Right? So return minus this cost of trading. That's what they're trying to get at. And they're going to regress. So the beta is going to be the difference between this and the difference between the market return and the market cost of trading. Right? So what you would like to see, remember, usually we don't have this cost of trading. In standard capital, we totally ignore this cost of trading. What this is going to do is let's think about this cost of trading. Let's put it in there and let's try and calculate different numbers. So there will be the covariance of return versus this market, the covariance of return. So that's your standard capital. Then the covariance of return, the trading cost of the market. Right? And this was the passive standard. Then there's the covariance of the cost of trading the individual stock that of the market, and the cost of trading. This is the commonality liquidity factor, the CI and CI. So they're basically breaking up this thing into 4 different factors. These are the 4 different factors that Acharya Peterson had. So this is our standard capital, except in the denominator we have something like this cost of trading. This is the commonality liquidity factor. This is the passive standard, and this is CI. So they have these 3 different factors and 4 different factors, and they have 4 different data. Notice that the lambdas are the same there. So one of the tests in this model should be that the lambda is the price of risk should be zero. You will see that. Okay. And they also control for the level of cost, the level of liquidity. Okay. So look at Acharya Peterson. So they should be looking at this beta net, and the beta net is basically this is beta 1 plus beta 2 minus beta 3 minus beta 4. It is not exactly beta because the denominator is not just the variance of return, but you get the picture, something similar to the betas. Okay, so this is the number they focus on, right? So how do they do this? They are sorting on portfolios. So they sort on illiquidity portfolios and illiquidity risk portfolios. What is the measure of liquidity? They use the MU measure. Right? Do the absolute return on non-trading on average over the market. So they take the illiquidity portfolios, liquidity measure using MU, sort, get these 25 portfolios, high, low illiquidity. They also do it with volatility of liquidity, high to low liquidity, and they have these 25 portfolios, and they're running these regressions of returns on these betas that are estimated. And of course, there's a lot of stuff that goes into the estimation, but those are details. So what they're doing here is trying to get an estimate of this beta net, and this is what they focus on. So look, this beta net is priced. Right? There's a price of this. This is the lambda. Right? So the beta net is priced. When you look at the beta 2, beta 3, beta 4, one thing that does show up is that they are not the same. Right? Remember, I said when you look at these, the lambda should be the same, price of risk should be the same. We don't see that. But what they focus on is let's force the betas to be the same, force the lambda to be the same, the price of risk to be the same, and this is what they find. And they come up with measures of risk for the different components of their these 4 different components, right? So this is our standard. So they have different. This is about 8%. So the total overall return liquidity risk is about, they say it's about 2.3% or so, and this is like 0.08 of that, this is 1% of that, and this is the remaining portion. Okay. So they are able to break it up by looking at this. That was the focus of that paper. But the idea is liquidity risk again seems to be priced. Right? Last Sabo showed it 7.5%, that's kind of high, but this seems more reasonable, and the Pastor Sabo measure is not much lower than what the Pastor Sabo had found. SARCA. So now SARCA, what it does is it estimates the permanent and temporary component of the price impact of each stock. And remember, I showed you that price impact equation when we estimate the price. So he's doing something similar. Again, you have the true price, random walk. There is the impact phi, the impact. This is the dollar volume, and that's just the price change. Okay. And he basically runs the AR1 model for the price change for the dollar volume, takes this error term, which is what you're going to use in the regression. This lambda is what you're ultimately going to focus on. Right? So this is going to be the price impact measure that you focus on. The change in dollar volume, the unexpected dollar volume, is what you're going to focus on. This lambda. And therefore, he estimates the other measures of price impact, possibly permanent price impact, temporary price impact, and he has this 5 lambda marker. Ultimately, he's going to focus on this. Right? He says, is this priced? That's the question. And the question that Sarkar was asking was, if we condition on this lambda, the price impact measure, can we try and explain momentum and the anomalies that we already know that are out there, big anomalies, momentum and post-economic contract. That is what we like. Right? So he's going to take this lambda measure and ask the question about momentum. So what does it do? He found this momentum portfolios from low to high, right? So these are high returns on momentum and low return. These are the risk-adjusted returns, the bars, and the dots are the loadings on that lambda, right? So once you estimate this lambda again every month, you're going to get this lambda, you're going to run. So this becomes a factor, and then you're going to run time series regressions on this lambda. So take a value-weighted average of this, run time series regressions of individual stocks, get the betas, and see if the betas are priced, right? And so basically, these are the factors. These are the betas. And there seems to be a relation between the betas and the returns of momentum portfolios. And that's what he argues is, look, maybe liquidity risk can explain momentum. Right? Momentum has been one of our major anomalies, right? We don't understand momentum. Right? 1% a month, that's huge. Of course, in 2019, negative is 80%, so maybe there's something to be said for momentum being this extreme, right? That occurs once in 2 years. But what Sarkar is saying is something different. He's saying liquidity risk can explain momentum, right? Can explain anomaly. He has a similar graph for post-earnings announcement chart. Pharma in '98 had a JFE paper where he talks about the fact that post-earnings announcement drift and momentum, so price and earnings momentum, are the two main anomalies that we do not understand. Right? And that's what Sarkar is doing after he's saying, look, liquidity risk can tell us about what's happening in momentum portfolios and what's happening in post-earnings announcement drift portfolios. Right? So liquidity risk seems to matter for our anomalies. Okay. So what we have just done, I showed you that the level of liquidity matters, liquidity risk matters for the cross-section of expected returns. Right? That is the state of the literature. Let's talk about liquidity having an impact on efficiency. Right? The question is, why does liquidity matter? Right? Why do we care? Right? I showed you that it matters for asset pricing in terms of the level. It matters for asset pricing in terms of liquidity risk. And now I'm going to show you that it matters for market efficiency. Right? There's been research in this. So let's take it. So the paper we talked about speed of convergence to efficiency. I'll show you some results. We also will look at impact of liquidity on efficiency. and the law of one price. Right? And I especially like this paper. It's really simple. Right? The idea is you have futures and you have stocks. At the end of the day, the basis between futures and stock should be small. And they show that independent liquidity of the underlying asset. So let's take a look. And we'll look at liquidity and auto-correlation in stock returns. Right? Yes. So speed of convergence to efficiency. Again, tax data, we're going to look at the 150 largest stocks in 3 years, 96, 99, and 2002. And the reason we chose this is because in 97, there was a tick size change. In 2001, there was a tick size change. And so we are sort of spanning these tick size changes. Let's see what happens in the different regimes. So we're going to run time series regressions for each stock. And we're going to use the midpoint returns to calculate intraday returns. Right? The idea is you do not want to get into the bid-ask bounds. Remember the Roll paper, the famous Roll paper talked about the bid-ask bounds, which was the negative serial correlation to estimate spreads. But the idea is we don't want that noise now when we are estimating returns. Right? We don't want bid-ask bounds. So we're going to use the midpoint of the bid-ask spread, closing bid-ask spread, at different time intervals, at 5 minutes, 10 minutes, and so on. So we'll use the midpoint of the bid-ask spread to get our return and estimate our regression. Let me show you what we do. So we are estimating at 5 minutes, 10 minutes, 15 minutes, and 30 minutes, and 60 minutes. So these measures of returns are estimated at different time intervals. The idea is how quickly does market become efficient, right? And the idea is how quickly is order imbalance absorbed by the market. And order imbalance is, remember, once we have the Lee-Reddy algorithm, we can sign trade as buy and sell. Once we have a signed trade as buy and sell, we know how many buys there are during the day, or how many buys are during this 5-minute interval, or 10-minute interval, or 15-minute interval. So we know exactly how many buys versus sell was there. What was the order imbalance? Right? Once we know the order imbalance, we want to see how quickly that order imbalance is absorbed. Right? So let's take a look. So this is the lag order imbalance and number of trades, and not lag order imbalance and shares. Sorry, dollars. So you can actually figure out how many dollars were bought versus how many dollars were sold, or how many shares were bought versus how many shares were sold, or the number of trades, how many number of buys were there, or how many number of sells were there. Okay? So we're going to look at number of trades and dollars, and we're going to see how quickly this is absorbed in the market. Right? Trying to get an idea of efficiency. Okay? So if you follow this coefficient, I guess this coefficient is in 60 minutes. Right? Remember, what we found is when you look at across days, right, using daily data, there's no serial correlation, there's no impact of order imbalance across days. But at some point it dissipates, right? This impact, it will have to be absorbed by the market. It has to be absorbed by the market. The question is, at what interval is it absorbed? Right? How quickly does the market become efficient? That's the question. Right? And in terms of by the time you get to 60 minutes, it is definitely absorbed here. So this was in 1996. If you look at 1999 and follow this coefficient, it's getting much sooner. It's getting absorbed in 30 minutes. If you get to 2002, look at the tick size is going down across this. If you get to 2002 and follow this across, you're almost getting absorbed in 15 minutes. The market is getting more and more efficient. And of course, we have to worry about some standard errors and stuff because of cross correlation again. But the idea is, how quickly is the market able to absorb order flow? And it turns out, in 2002, somebody should update this study. Maybe in 2012, it's getting absorbed within 5 minutes, who knows? Because there's so much high frequency trading going on, right? These guys are providing liquidity estimates, putting inside quotes all the time, putting things. Right? The question is, how quickly are they doing it? Right? Is the market becoming efficient very, very quickly? Is the order flow being absorbed very, very quickly? Remember, I also told you that the size of the orders has gone down. Right? I showed you that graph. The size of the orders has gone down. The amount of number of trades that are less than $10,000 has gone up tremendously. Right? So it must be becoming easier to absorb this order flow. Right? The market must be getting more efficient. Right? And we actually see this when we look at intraday volatility at 5-minute intervals, or when we look at hourly to daily variance ratios. Right? If you look at hourly to daily variance ratios, are we moving closer to a random walk? And we see that they are. Right? So markets are indeed getting more efficient. And some people say, yes, the high frequency traders are indeed making markets more efficient. Right? But the debate with high frequency traders are, do they hurt the market, especially if you have this flash crash and stuff. Right? So this is again interesting stuff going on in liquidity in markets. So lots of debate. But here what we show is within 15 minutes by the time we get to 2002, the order flow is absorbed. Okay, liquidity in market efficiency. So the follow-up paper was again that data 93 to 2002. We took the 193 largest NYC stocks. We calculated valuated portfolios of these, and we run the time series regression of each portfolio. Again, Bitcoin return for 5-minute intervals, and W variable to illiquid days. So the idea is what happens on liquid versus illiquid days, and how quickly is order imbalance absorbed on liquid versus illiquid days, right? So if you're looking at different regimes, 8, 16, and decimal, this is the text size. And we find that the impact, this is the more illiquid days, right? The impact is of order imbalance is higher on the more illiquid days, right? Suggesting that liquidity matters for efficiency. Right? How quickly can the market absorb order flow matters, whether it's an illiquid day or a liquid day. Right? And it matters across different regimes, 8, 16, and so on. That we have other stuff that we do, but this is the main thing. Illiquidity matters for market efficiency. Right? So remember, I'm trying to make the case that liquidity matters for asset pricing, level, and liquidity risk. It matters also for efficiency. We see that there. Law of one price. So this is we look at the NYC composite index futures contracts because we have measures of NYC liquidity measures, right? So we have to use equivalent futures contract, composite index futures contract. We adjust spreads and basis for time series variation. You don't want standard time series variation to show up. Like there are day of the week effects, for example. So you want to get rid of them. Sample period 88 2002, and this is the you have daily data on the basis. I'll talk about the basis in a minute, and the evaluated quoted and effective spreads. Right? So the idea is, does that have an impact on the business? So what's the basis? Remember, if you have a futures contract, you have a spot, there has to be an arbitrage relationship between them. Right? And the idea is, you have this is delta is the dividend yield on the NYC. The idea is this is the basis. This should not like arbitrage relation should restrict how much this could buy. Right? And what they're going to show is this basis depend on liquidity. Right? So that's it. So here we have the lag variables, quoted spread and effective spread, and the basis are measuring over 3 month, 6 month, and 9 month contracts. And they see at least for the year contracts, there is a huge impact of liquidity basis, right? Or illiquidity rather, quoted spread. Higher the quoted spread, the manipulated quoted spread, higher the basis. So the law of one price seems to depend on liquidity. And I don't know if you go back and look at papers by Bakshi and Chen, he had an first paper in 1990 sometime, in the 1990s. He looked at the violation of the put call parity. Right? And he also talks about the violation of put call parity may be due to liquidity impacts. Okay? And I don't know if that's been updated, but maybe somebody should look at that and see what's happened to violation of put call parity in over time as efficiency, as market efficiency has improved. I suspect that the number of violations has gone down. Right? We showed that there were a huge number of violations, at least so again, very simple idea. Law of one price depends on liquidity. Okay? So liquidity matters for efficiency. Let's talk about liquidity and order correlation in stock markets. So, and the idea here is we know that there's at high frequency, at weekly and monthly frequency, there is negative serial correlation in stock returns. Right? If this negative serial correlation is there, and Jagdish had a paper in 1990, Bruce Lehman had a paper in 1990, and they showed that you could make returns of almost 2.5% a month. Right? Huge returns by conditioning on this negative signal correlation. Right? This reversal that we talked about at high frequency, monthly increasing. So we're going to test this. We say, okay, let's take a look at this reversal profit and see where they're coming from. Okay? That's the idea here. So let's take a look. So NYC AMX stocks, 62 to 2002. You sort in past returns, turnover and liquidity. Literature shows that high turnover stocks have more reversal. So we've got to control turnover. There's negative signal correlation, and the liquidity we use is the annual liquidity. Right? I told you it's easy to use. Okay, so let me show you what this graph is. So in week 1, you can sort on these 3 factors: return, turnover, and illiquidity. So let's forget turnover and illiquidity for a second. The idea is if return has been high in the previous week, in the cross-sectional sense, it's going to fall. If it's been low, it's going to come back. That's the reversal serial correlation that we know about, right? At high frequency. We know this, that is the So in the previous week, let's sort on these 3: return, turnover, and liquidity, and let's see what happens in the next week. Right? So these are return portfolio ones. These are negative returns. They are all positive here in the next week. These were positive returns. These are negative in the next week. Right? But look at what's happening here. If you look at liquidity, those that were negative in the previous week are positive, but they are more positive for the more illiquid stocks. There seems to be an impact of liquidity on serial correlation. Right? When you see that, you get there is more negative returns on the more illiquid stocks. Right? So illiquidity seems to matter for the negative signal correlation in returns. Right? Well, let me show you some. These are different sorting criteria. These are losers minus winners, high turnover, high illiquidity. Right? So look at sort weighting. Weight or so 2.69% a month. Huge return. 2.69% a month. Again, losers minus winners, high turnover, low illiquidity means more liquidity, it's much lower. Okay? So liquidity seems to matter. The more illiquid, the higher the these are reversal profits. They are higher for the more illiquid stocks. Okay? And we see that huge. And it's across the board. I think you look at across the board, but how you weight it doesn't matter. Right? Same with whether turnover matters. Again, it's high versus low, illiquidity doesn't matter. And you will see this again. So now what we do is we try and control for trading costs. Right? So there's a tiny Mahan paper, there's Goralik and Sarka paper that actually try and estimate. So Goralik and Sarka tries to estimate price impact measures. Right? And they did it with momentum, but we got the data and let's see what happens. And this is Kyle and Mahan. They actually looked at how much institutions are trading and what is the cost of trading that institutions face. So they had actually data that from institutions. It's like the conservative data. So the raw return 1.83%, take turnover in liquidity portfolio, but look at low liquidity portfolios after you account for the transaction cost. Remember, I said the profits are higher in the high illiquidity portfolio or low liquidity portfolio. So if the portfolio is illiquid, it's going to be harder to trade. You're going to pay more in transaction costs. And after you pay for transaction costs, right, these are all negative. If you look at winners and losers, right, hugely negative. So there's no profits to be made after you control for liquidity in this negative serial correlation. Right? This was a big paper in 1990. This was a big idea at that time. Look, markets are no longer efficient. You can make 2.5% a month by conditioning on past week's return, the negative serial correlation in the cross section, right? So the point is, look, no, it's not there. It's because you're not controlling for liquidity, you're not controlling for transaction costs. The profits are not there. So liquidity matters for efficiency. It has an impact on market efficiency. So there's a recent JF paper, stock market liquidity and the business side. So let me stop here and summarize it, how far we have gone. So we looked at the impact of the level of liquidity on asset prices. We looked at the impact of liquidity risk on asset prices. We looked at the impact of liquidity on efficiency. Right? Rigorously correlation. We looked at how quickly order flows absorb. Right? So at law of price. So liquidity matters for efficiency. Recent paper, very interesting paper I thought. It's trying to say that stock market liquidity has ability to predict the business cycle. Right? We should take a look at this paper, very interesting paper. Right? In the stock market, liquidity, not returns. Liquidity is a leading indicator of the real economy. Right? So liquidity has some macro connotation, and that's interesting. Okay, so these are looking at the recessions. I don't know if you can see the dark lines back there. There are dark lines and shaded lines, I should say. And this is illiquidity. Right? So in recession, it seems that the illiquidity is jumping up. Right? That's what again, this is formula. What they're finding here, this is quarter relative to the recession quarters, and these are the recession quarters. I don't know if you can see that middle quarter sort of. And this is illiquidity. Look at what's happening with illiquidity right around as the recession is happening, and then it's starting to come back down. This is trying to suggest that stock market illiquidity has some predictability for the microeconomy, for the business cycle. That's interesting. So here they're trying to say is, let's look at the quarter relative to the recession. The recession are the middle here. So this is the illiquidity that we just saw. And this is term spread. Yeah, so this is the term spread. So we know that the term spread does become negative right before the recession. We see this, right? And liquidity is also but take a look at this. This is the default spread. Okay? This is triple B minus triple A part. Term spread is long term and short term. So this is default spread. And liquidity seems to be leading even the default spread. Okay? Default spread and term spread are standard measures of macroeconomic business cycle. Okay? And you see liquidity, stock market liquidity, valuated, seems to be leading even the default spread. And here we have the market return. Like it's liquidity is market return. Yeah, it goes down, but not as starkly as the way liquidity changes. And this is volatility. This is VIX. Not that much of an impact compared to what's happening with respect to liquidity. Stock market liquidity has some predictive power for the macroeconomic business cycle. I thought that was interesting. Okay, liquidity is important. So summarize. Liquidity has an impact on expected returns and thus the cost of capital. There are pricing implications, level of liquidity, liquidity risk, and liquidity impacts market efficiency. Right? You saw that? And liquidity predicts business cycle. Liquidity is important.